My name is Dr. Madhyanamaya. I am working at TB Siddhartha College of Arts and Science, Mogal Rajapuram, Vijayawada. My topic is funds flow statement. My topic is funds flow statement. The basic financial statements are two. One is balance sheet, another one profit and loss account. One is balance sheet, another one profit and loss account. The balance sheet discloses the financial position of a business enterprise. Balance sheet refers to disclose the financial position of a to disclose the financial position of a business organization, whereas on the other hand, P&L account disclose the profit, net profit or net loss on activities, on trading activities. Result of trading activities means net profit or net loss. Net profit or net loss. Here, here two balance sheets are given. One is 90, another one 91. Two balance sheets are given. One is 90, another one 91. In the year 90, plant and machinery stands for 20,000. In the year 90, plant and machinery stands for 20,000. And in the year 91, the value of plant and machinery is 25,000. In the year, the value of plant and machinery is 25,000. In 90, 20,000. In 95, 25,000. The difference between these two periods is 5,000 rupees. The difference between these two periods is 5,000 rupees. 5,000 rupees denoted may be purchase or sale. 5,000 rupees denoted may be purchase or sale or depreciation or appreciation. Depreciation or appreciation. So, to find out the reason to increase the value of plant and machinery, to find out the reason to increase the value of machinery by 5,000 rupees, another statement to be prepared. Another statement to be prepared. That statement is called funds flow statement. That statement is called funds flow statement. That statement is called funds flow statement. Both these funds flow statement. The funds flow statement has to be undertaken or prepared to show the changes in the assets and liabilities from the end of one period of time to the end of another period of time. The statement is called statement of changes in financial position. The statement is called changes in financial position or a funds flow statement or a funds flow statement. The funds flow statement defines a statement which shows the movement of funds and is a report of the financial operations of the business undertaking. It indicates various means by which funds were obtained during a particular period and the ways in which these funds were employed. In simple words, it is a statement of sources and application of funds. Statement of sources and application of funds. Meaning and concept of funds. Another one, meaning and concept of funds. Meaning and concept of funds. Here, fund means there are various meanings are there. There are various meanings are there to word funds. To word funds. In a narrow sense, in broader sense, and popular sense. In a narrow sense, in broader sense, in popular sense. In a narrow sense, in a narrow sense, funds means. In a narrow sense, funds means a cash. In narrow sense, funds means a cash only. Funds means a cash only. And funds flow statement prepared on the basis is called a cash flow statement. In the narrow sense, funds means cash only. In broader sense, funds means 4M's. In broader sense, funds means 4M's. In broader sense, funds means 4M's. 4M's stands for men, material, machinery, money. Men, material, machinery, money. 4M's stands for men, material, machinery, money. Whereas in popular sense, whereas in popular sense, funds means working capital. Funds means working capital. Working capital is called current assets and minus current liabilities. Working capital is called current assets minus current liabilities, or the excess of current assets over current liabilities. The excess of current assets over current liabilities. The excess of current assets over current liabilities. That is called working capital. That is called working capital. Working capital means to purchase of raw material, to purchase of raw material, payment of wages, and do day-to-day expenses. Day-to-day expenses. How much amount to be required for these three operations? That required amount is called working capital. That required amount is called working capital. One is purchase of raw material. Second one, payment of wages. Third one, day-to-day expenses. How much amount to be required for these three activities are operated? That required amount is working capital. That required amount is working capital. So next one, flow. Flow are two types. Flow are two types. One is inflows and another one outflows. One is inflow and another one outflow. One is inflow and another one outflow. Statement. You already know what is statement. You already know what is statement. Flow means flows are two types. Flows are two types. One is inflow, second one outflow. One is inflow, second one outflow. Outflow. Next, they they understand flow of funds. They understand flow of funds. It is essential to classify various accounts and balance sheet items into current and non-current categories. To understand flow of funds, it is essential to classify various accounts various accounts and balance sheet items into current and non-current categories. Current and non-current categories. Current accounts can either be current assets or current liabilities. Current assets are those assets which of the ordinary ensues of business can be or will be converted into cash within a short period of normally one accounting year. Current assets and current liabilities. Current assets means any asset to be converted into cash within 1 year. That is called current asset. Once again, current asset means any asset to be converted into cash within 1 year or within a short period. Within a short period. That asset is called current asset. That asset is called current asset. Second one, current liability. Current liability. Any liability to be paid within 1 year. That is called current liability. Any liability to be paid within 1 year. That is called current liability. That is called current liability to be paid within 1 year. That is called current liability. Current liability or within a short period. Within a short period. That is called current liability. Next, another one. The funds flow. The funds flow statement. Another funds flow statement. Funds flow next funds flow statement to be prepared with in 3 stages. Funds flow statement to be prepared in 3 stages. In first stage, we have to prepare statement of changes in working capital. Statement of schedule of changes in working capital. Funds flow statement may be prepared in 3 stages. In 3 stages. One is schedule of statement of changes in working capital. One is schedule of statement of changes in working capital. Second one, adjusted P&L account. Adjusted P&L account. Third one, statement of application of statement of sources and application of funds. Statement of sources and application of funds. The following are the 3 stages to prepare the funds flow statement. One is statement of schedule of changes in working capital. Second one is adjusted P&L account. Third one, statement of sources and application of funds. Statement of sources and application of funds. In first stage, we have to prepare statement of schedule of changes in working capital. In working capital. At this time, we have to prepare statement of schedule of changes in working capital. We have to take only current assets and current liabilities. We have to take only current assets and current liabilities. What are current assets and current liabilities? Here, current assets are any asset to be converted into cash within 1 year or within a short period. That is called current asset. Second one, current liability. Any liability to be paid within 1 year or a short period. That is called current liability. So, current assets and current liabilities are to be taken into consideration. Current assets, those are CCI BDI. CCI BDI. CCI BDI stands for C, cash in hand. C, cash at bank. I for investments. Here investments are marketable or short-term investments. Marketable or short-term investments. BDI. B for bills receivables. D for debtors. I for inventory. I for inventory. Here current assets are CCI BDI. C for cash in hand. C for cash at bank. I for investments. Here investments are two categories. One is short-term investments and are temporary investments or marketable investments or marketable investments. Whereas current liabilities are bills payable, creditors, bank overdue. Bills payable, creditors, bank overdue, or debentures to be paid within 1 year. Debentures to be paid within 1 year. That are called current liabilities. So, in this category, or to prepare statement of schedule of changes in working capital, we have to take only current assets and current liabilities. The resulting figure is known as decrease or increase in working capital. The resulting figure is known as decrease or increase in working capital. If current year, if previous year working capital is more than the current year working capital, if previous year working capital is more than the current year working capital, or current year working capital is more than the previous year's working capital, the difference between these two are known as increase in working capital. Increase in working capital. If current year working capital is less than the previous year working capital, if current year working capital is less than the previous year working capital, that is called decrease in working capital. Decrease in working capital. Decrease in working capital. So, statement of schedule of changes is completed. Another one, adjusted P&L account. Another one, adjusted P&L account. This adjusted P&L account to be started with first one, profit, first one, reserve, second one, retained earnings, third one, profit, current year profit, third one, current year profit. Next, the adjusted P&L account. The adjusted P&L account to be prepared at the time of prepared of adjusted P&L account. First one, current year capital or reserve or retained earnings to be taken into consideration. Retained earnings to be taken into consideration. In debit side, non-business operations are to be recorded. One is depreciation. Credit side, in this statement, debit side, the following items are to be recorded, whereas credit side, the following items to be recorded. In debit side, the following items are to be recorded. One is depreciation. One is depreciation on current assets. Depreciation on current assets. Depreciation in case of current assets is known as reserve. Depreciation in current assets is known as reserve. Whereas depreciation in fixed assets is known as depreciation. And third one, third one, in intangible assets. In case of intangible assets, the assets value to be gradually decreased, that is called amortization of goodwill. That is called amortization. That is called amortization. So, reserve is to be used in case of decrease in current assets. Depreciation is to be used in case of fixed assets. Value is decreased. Third one, amortization. Amortization is used in case of intangible assets. Next, third one, dividends paid to be recorded in debit side, P&L adjustment account. Whereas in case of credit side, received dividends. Next item. Loss on sale of assets to be recorded in debit side. Loss on sale of assets to be recorded in debit side. Whereas profit on sale of assets to be recorded in credit side. Whereas profit on sale of assets to be recorded in credit side. Next one, tax paid to be recorded in debit side. On the other hand, or credit side, tax refund to be recorded in credit side. Next, dividends received to be recorded in debit side. Dividends to be paid to be recorded in credit side. Dividends to be paid to be recorded in credit side. After completion, the above items are to be posted in adjusted P&L account. The adjusted P&L account discloses A. Sources of funds or loss of funds. Funds from operations or funds loss in operations. The adjusted P&L account discloses funds from operations or funds loss in operations. Another one, sources of application of funds. Statement of sources and application of funds. In this statement, left hand side recorded sources of funds. Right hand side to be recorded application of funds. In debit side, left hand side sources of funds. Right hand side application of funds. Sources of funds means any asset to be sold. Application of funds, any asset to be purchased. One. Second one, sources of funds, rise in capital, issued capital, application of funds, decrease in share capital. Another example for sources of funds, issued debentures. Another one, application of funds, repayment of debentures. ఈ విధంగా funds flow statement may be prepared in 3 stages. One is statement of schedule of changes in working capital. Second one, adjusted P&L account. Third one, sources and application of funds. And third one, sources and application of funds. These are the 3 important statements to be prepared in funds flow statement to find out the funds. What comes in various causes, what goes out, various causes are there. To find out the cause, we have to prepare a separate statement that is called funds flow statement. Funds flow statement is also known as where funds are needed, where funds are sourced, where funds are applications. Thank you, one and all.